Let's start with the very basics of foreign exchange. First, let's understand what an exchange rate is. An exchange rate is nothing but the price of one nation's currency expressed in terms of another nation's currency. For example, the US dollar against yen, US dollar JPY, or simply called the yen. The US dollar is the base currency and the yen JPY is the counter, or sometimes called terms currency. So a USD JPY rate of 113.36 means that for $1 you get 113.36 yen. FX rates can be found online from a number of websites. You can get FX rates on yahoo.com, on FX Pro, FX Open, XE, Oanda, forex.com, FXCM, etc. There are also two parties to an FX transaction that use the exchange rate: the price taker and the price maker. The price maker is also called the market maker sometimes. And there are also two sides to quoting the exchange rate, the bid and the ask. So depending on the role of the trader, whether the trader is the market maker or the price taker, the bid could be the buy rate or the sell rate, and the ask could be the sell rate or the buy rate. The market maker buys at the bid and the price taker sells at the bid, and vice versa. The market maker sells at the ask and the price taker buys at the ask. So the foreign exchange market is an over-the-counter market, meaning that the deals are transacted between participants connected through a private network that we will look at when discussing the foreign exchange landscape. At the core of the trading network, market making occurs between dealers of banks connected electronically by private networks such as Reuters or Bloomberg. These interbank dealers or market makers are constantly creating prices by updating them according to the actual market prices, actual dealt prices, and they trend prices according to what they anticipate the market to be, and also depending on their positions. So for example, if the market maker is long dollar yen and he's looking to sell dollar yen, he would typically quote an ask rate lower than the market rate, hoping to be taken. So we will look at all that more in detail later on. Updating the price which we see on our screens, on websites or on screens such as the Reuters, is done electronically by the market makers on networks such as Reuters or Bloomberg. So these interbank dealers or market makers are constantly creating the prices by updating them according to what they think the actual market prices are, or trending prices according to what they anticipate. This is done electronically through a price updater such as Reuters terminal. The dealer has access to this special terminal where the dealer manually changes the price depending on multiple factors such as the last traded price, the perceived price, or the trended price. For example, a market maker might get taken on the ask side of the quote, creating a short position. In order to cover his shorts, he might need to trend the price higher in order to get given on the bid side. On highly volatile movements, when the currency pair rallies or falls, sometimes dealers do not have a clue as to where the prices dealt are. Hence, there are no updates by market makers and therefore forming price gaps. It's only when a market maker updates a price on the terminal, a price tick forms that gets saved into the database, and then that's aggregated to form charts with varied intervals such as the 5-minute, 15-minute, 30-minute, hourly, 4-hourly, daily, weekly, etc. Prices can also be obtained from sources such as the EBS, the Electronic Broking Services. So the Electronic Broking Services is a wholesale electronic trading platform used to trade FX with the market maker banks. initially in the 1990s, the Reuters Dealing 2000 and the Reuters Dealing 3000 had a monopoly in the interbank spot foreign exchange market. So all trades would flow through the Reuters dealing system. So EBS was created by a partnership of the world's largest foreign exchange banks to challenge the Reuters monopoly in the interbank market. Another point to understand is that in the foreign exchange market, there are two methods of trading. One is by placing orders, such as the EBS's CLOB, which is the Central Limit Order Book. The Central Limit Order Book is a centralized database of limit orders and is a trading method that is used by exchanges globally. It is a transparent system that matches customer orders by matching the highest bid with the lowest offer. So in this CLOB model, the customers can trade directly with the dealers can trade with other dealers, and customers can trade with other customers. Now, in contrast to the CLOB model is the request for quote model, which we will look at when discussing the interbank or the investment banking market. So the request for quote trading method, the customer contacts his or her banks for a price. So they have a set of banks that they deal with, market makers who quote a bid and offer to the customer. And as we've mentioned, if the customer wishes to buy, they would hit the ask side. And if they're willing to sell, they would hit the bid side. So in the RFQ model, it's important to note that customers cannot trade with other customers, and the customer cannot be the market maker. So the market maker are dealers in banks. So the closest competition to the Reuters Dealing 3000 is the EBS, and the decision by a trader and foreign exchange trader to trade using the EBS or Thomson's Dealing 3000 is dependent on the currency pair. So we will discuss more about how the foreign exchange landscape works when we move to the technical analysis section. Next, we will look at the concept of direct and indirect quotes.